Alrighty everybody, today is Wednesday the 27th of March 2013, and as promised I'm giving you my daily analysis video of the markets. This will be a very lengthy video. Usually my videos are about 11 to 15 minutes. However, this one will be a little bit lengthy, and the reason for that is I have a little bit of cycle work I want to show you, some of my proprietary methods that you will get in this video inherently for free. And also I want to look at some of the trades that I took today. All winners, up by about $730, so whoever took them with me, congratulations, you did well. And I want to kind of go into a couple of things as far as market leaders and so forth. Okay, so let's just look at the Spiders 10-minute chart. Now in the morning, Spiders gap down, and remember a couple of videos ago I told you that for the most part what the Spiders have been doing recently is gapping up or down. It's even hard to say that, up or down, depending on what's going on in the markets. I mean, you know, and all of this, really all this choppiness here is the uncertainty in Cyprus, and that's all it really is. But at the same time, this is also distribution. Okay, so the underlying factor here, even though we're talking about Cyprus, is distribution. Okay, so distribution generally is a sideways movement at the top, okay, at the tops of charts. So I have to look at the daily, okay, and this generally occurs, okay, when we get these kind of rounding areas right here. So right now obviously we're at this top in the Spiders, and now everybody's saying, oh, we're either gonna go even higher or we're gonna sell off or whatever. I'm gonna get into that, but nonetheless what I'm seeing here is distribution. And if you look at distribution recently, look at the volume. Like for example, when we had this up move right here, it was mostly on very good well, actually it was on low volume, but it was on these green candles. So this up move, you could argue, was on light volume. Okay, and then we had a little bit of selling right here. Okay, but now the volume is even lower. But now we kind of, like I said, we have these gaps every day. So one day we gap down and we have this red, you know, bar right here on volume. Then we gap up, we have a green one, and it kind of oscillates back and forth. And all of this really is mostly because of the news in Europe. So you have a red day and a green day, red day and green day. So there's a lot of indecision. But now the argument is this really distribution at the top where we expect some sort of sell-off now? Or is this just some sort of consolidation to go higher? And honestly, the arguments are good on both sides. Now me personally, if you ask me what I'm thinking, is that we're probably going to have a little bit of choppiness here, maybe into next week or so, maybe even a little bit downside, but I don't really expect more of a pullback than maybe up to this blue line right here, which is the 50 MA. Maybe if you're a bear, you get lucky and you make it to this 148.67 level, but ultimately if you look at my work right here, as far as the extensions, I see that the Spiders should ultimately get to this 161.90ish, 162 area. Now all of this is speculation, so I have to look at it day by day. So in a week all of this could be completely negated and I might form a completely different opinion. However, based on what I have now, I think that we might have a little bit of a sideways move, and maybe if some other countries in Europe show weakness, like they're talking about Italy and Spain, maybe even a little bit of a pullback, okay, but no more than this 148.60ish level, and then up, okay, into this 162 area. And ultimately I think my cycles are telling me that around June we should start that sell-off, around May or June. Okay, now a lot of analysts are talking about how we've always put in tops around April, and you know, their arguments are just as valid. We could put in a top around April. However, me personally, I think that top will be put in around May or June. So we're all agreeing on that this market is going to reverse, that this market is going lower, and I'm talking, you know, we're all talking about these big moves. So if you look at the spiders, okay, if you look at between October 2007 and March 2009, we're talking about this big move where in essence half of whatever the spider was is basically negated. So you went from 156, 157 to about 67. So basically it lost half of its value. So we're talking about a big move. Okay, we're not talking about a small move. So we're talking about a major, not only correction, but we're talking about actually being in a recession. Okay, and of course, you know, recessions, you don't find out about them until after the fact because they're based on, you know, the quarterly GDP values. But I'm just saying that we're talking about something on a bigger scale. So anticipate that very soon, okay? And it's just a matter of time when that is going to be. Some are talking about April, me personally talking about May, June, maybe even a little bit upside into the rest of the year. I mean, there are arguments that the rest of the year we might just have a slow bleed, then a little bit up, and then into 2014 we might get that sell-off. All arguments are valid, and the reason why you really can't pinpoint it is because it's too preliminary. Okay, all we have is just this triple top right here on the spiders, and I'm gonna have to zoom out here. You have this triple top right here on the spiders, and now the question is, do we go higher or lower? Now usually when you look at triple top patterns, usually you break out of them. It's the double top, the second time that this area is hit, that's when you get the real sell-off. So now it's not really as strong a level as this time around right here. Nonetheless, you know, you have to, you know, give it credit, and you have to understand that we're into a major resistance. Okay, so we might get a little bit of a you know, upside into 162. Another level that I have right here is 171. So if those analysts who are saying that we might have more upside into the rest of the year, if they're right, then we might even get more upside into this 171 area. However, me personally, I think around May or June, that's when it all starts. Maybe a little bit slowly at first. Okay, maybe we might need to see some of that distribution, because you have to think about everybody that bought around here, right? Those hedge fund managers and, you know, all of those big guys are going to have to get rid of their positions, and so maybe we're going to need to see some sort of distribution here. Now if you're the little guy that has a 401k, and you're looking at this screen, this is your reason why 401ks don't work. Okay, so look here, let's say that you got into your 401k around the year 2000. Okay, so this was the worst time you could have gotten into the markets, 2000. Where are you now? You are at the same level. So basically you had a panic twice, right? So you put your money into the markets here in 2000, sold off the first time. So I'm pretty sure, you know, when your money is halved, I'm pretty sure you're going to have a panic attack, right? Lo and behold, you stuck through it, and then of course then it started reversing. You started, you know, being a little bit more happy about it, and then it came back to where you were, okay, 7 years ago, and then you started selling off again. So basically 13 years later you are at the same level where you were before. And I'm not talking about inflation, I'm not talking about, you know, higher food prices or any of that. So basically your money is not worth the same now, obviously, as it was 13 years ago. So this is my argument. If you have a 401k or anything like that, if you are a long-term investor, your money is not working for you like it should. And that's why I day trade, that's why I swing trade, that's why I invest. And to me, investment is not something that I hold more than 3-4 months. So understand that when I say the word investment, I'm talking about, you know, riding a downtrend right here and only partially. But if you are a long-term investor and you're buying for decades, your money is not working for you. Okay, so that's just my little argument for not investing in 401ks and not investing for long periods of time in the markets. However, you do as you please. Now let's get back to the intraday on the spiders, and we'll get back to my little theories on the longer term shortly. And as I said, this will be a long video, so stay tuned for a little bit. Now, intraday we gapped down because of worries in Cyprus, obviously. What happened is that we gapped down below this 200 MA, the red line right here. We came into this gap fill right here, okay, bounced off of it. We had a little bit of trouble on the 200 MA, but we broke out of it and we went higher and higher. Had a little bit of a pause right here, naturally, because yesterday most of the buyers were right here, so they needed to get rid of their positions. And then once we got those buyers out of the way, we bounced off of the 20 MA and we closed at pretty much the highs of the day. Okay. Now, what I'm thinking is based on what we saw today, that tomorrow should also be an up day. And the reason being is that tomorrow is the last day in the markets of the week because of the Easter holidays. And so, you know, usually when you have these kinds of holiday weekends, these holiday weeks in the markets, we don't really see a lot of volume. And if you look at today, you will see that, you know, we didn't really do that much volume. And when I look on the side of my spiders, let me see here if I can find the volume. I believe we did about 80 million. I can't find the data right now, but we didn't do that much. Okay, we didn't do that much volume on the spiders. Let me just see here if I can switch to the daily to tell me how much volume we had. It says about 100 million on the spiders. Okay, so the volume was not all that great on the spiders. I believe it was less than that, but either way, both numbers very low. So, you know, you're not seeing a lot of volume because it's a holiday week, you know, and usually when volume is this light, that's when the retail buyers come in, and retail, you know, people usually tend to buy as opposed to shorting, and you know, that's when the big guys, you know, kind of don't even participate in the market. And as I said, right now we're in distribution, so the big guys, they want to sell. They want to sell to you little guys, you know, the guys who are going to buy and get stuck holding, you know, something at all-time highs. Okay. And so unfortunately, even though it's sad to say this, but right now what's happening is that these buyers, these retail buyers, are coming in and probably putting in their last dollar into the market that is about to reverse to the downside. Okay, even though it's painful to say that, it's the truth. That's what's happening right now. Okay, and so, you know, I'm expecting a little bit more upside tomorrow because, you know, then the media can go out and say, oh, you know, we closed out the week, you know, at all-time highs, or, you know, whatever they're going to say. Okay, so you never know if maybe, you know, we go above here. Anything is possible, you know, with the markets. But either way, they could just say, oh, you know, the week was great. We did, you know, the spiders were up this much, the Dow was up this much, or whatever. You know how the media are. But now what I want to tell you is, you know, even though they might be saying that, okay, they might be partially right. I expect a little bit more upside in this market, and the reason being is me comparing the spiders, which is what you see here, the ETF, and the spiders cash index, which is the SPX. So let me just try to give you actually an overview of the two. So what I'm going to do is I'm going to overlap the SPX, and hopefully I get the symbol right here. Okay, and did I do it? Let's see here. Here we go. Let me just change the colors for you so you're not confused, because they look the same pretty much. Okay, and we're going to make the cash one, we're going to make that one pale. Okay, so what happens first of all is that you have these two indices, and the one with the dollar sign, the SPX, is the main index. This is the one that has all these, you know, notorious companies, and the one that we use to actually track the economy. Now the spider is the ETF that tracks the SPX. The SPX doesn't give you a dividend, but the spider does. So this one right here, this one that's a little bit darker, the one that I show you on my charts every day, that's the one that gives you a dividend. And that one gave out a dividend around this area right here, okay, which is when we put in this short-term top. And then of course, because of the dividend, it started going lower. Okay, So there was an adjustment for the dividend, okay, in the SPY right here. And if you look at the SPX right above it, you see that the SPX is actually into the same resistance area where it was about 2 weeks ago, whereas the spiders is not there yet, okay? And the reason why I say that we might have a little bit more upside is because the spider probably wants to get to this level right here, okay, just on a technical basis. It's still above this 20 MA on the daily, so on a technical basis the spider looks like it wants to go higher. And even you can argue on this candle right here, the last one we had, the one that we had today, it looks pretty nice, right? It looks like there might be a little bit of bullishness on the spider. And then of course the media and the Fed, what do they want? They want headlines. They want, you know, people to trust the markets. So I wouldn't be surprised if we got above that area and then above the all-time highs even further. When that might happen, I don't know. We might get a little bit of a pullback maybe into next week, and then ultimately a little bit of a surge higher. However, when you look at the SPX, the pale color right here, what you see is it is into this resistance right here. However, the more it stays around this area, that resistance will eventually be broken. So these two charts, when I kind of overlap them together, make a case for bullishness, however, short-term bullishness, okay? So, you know, eventually the market is going to say, hey, listen, I'm exhausted, I need to go lower. When that is, just look at the beginning of, you know, of my video, and I don't want to repeat myself, okay? So ultimately this is telling me that we might have a little bit of bullishness, and then, you know, as I was saying, maybe up even to the 161, 162 level, maybe even 171 on the SPY. However, it's too early to make that call, okay, for me to make that call. I don't want to go out there and make that call. It's just something based on my calculations that I see on the markets. I have to look at it day by day, okay? And you know, if we kind of look at the broad market, we are actually seeing some bearishness in sectors, and this is something that we call sector rotation. So when we're kind of ready to reverse to the downside, certain sectors will kind of start showing bearishness, and they will be the first sectors that do that, and then, you know, it kind of occurs as a domino effect, and then before you know it, we have that big sell-off, okay? And what I want to show you right now, for example, today, I remember I told you yesterday about the banks, and particularly JPM and Bank of America. Let me just delete this right here. Okay, this is JPM intraday, and kind of JPM threw us a little bit of a curveball today. And actually in my last video I said, listen, JPM looks like it's trying to break out of this bearish pattern right here. So my argument yesterday intraday was that even though it put in this big red candle, these two red candles, and consolidated to go lower, okay, it looks like it wanted to break out of that candle, out of that pattern, okay? And you can make that case because, you know, once you add on these last 5 candles, it's not really much of a bearish pattern. It's a really, really poor bearish pattern, okay? So based on this behavior in JPM yesterday, you know, I was giving you all these levels, you know, to short it, you know, for today if it were to go up with the market. Now the interesting thing is that the market went higher. I showed you the spider 10-minute chart. The market gapped down, but it just consistently went higher throughout the rest of the day. JPM, not at all. JPM was lifeless today. It just basically gapped down, but as soon as it gapped down, it started bleeding lower, and, you know, JPM just basically had a very, very poor performance. It was down 1.8% on the day, okay? And why is JPM important? JPM is important because the last year or so, JPM, I have been using it as a as a leading market indicator, okay? Because every time intraday that you saw, you know, a big green candle in JPM, lo and behold, what happened? The market started rallying as well. Not anymore, okay? So this, you know, this is another sign of bearishness. And, you know, like when you're trying to find out when the market will reverse, you're looking for not only one sign, but you're looking for you know, tens, maybe even hundreds of signs that the market might reverse. And for this, sometimes you have to look at the intraday. To the average investor who just looks at, you know, his or her portfolio every couple of months, they may not see this stuff. And that's why it's so good to be a day trader, because you're sitting in front of the charts and you see everything that's going on in the markets, okay? And you know, JPM, completely lifeless today. It did horrible, okay? And so keep this on your radar. And if you even look at JPM on the daily chart, you will see that JPM right now basically today gapped down below this 50 MA on the daily. When's the last time JPM was below the 50 MA? Right here, okay, December 2012, okay? So, you know, for about a quarter or so, JPM has been steadily climbing higher alongside the 50 MA, but now, today, it closed below the 50 MA for the first time, and that's significant, okay? And now remember, I keep telling you about Bank of America all the time, and I know, you know, I repeat it too much, but Bank of America is weak too, okay? You know, Bank of America today, if I look on the side right here, was down 0.4%, whereas the spider was flat, okay? And you know, like right now, Bank of America is holding this 20 MA right here. But what I'm thinking, and I know I keep telling you about my shorts, and a couple of people have asked me, when are you going to put out a Bank of America short? For me personally, not yet, because now I see a little bit of a down move right here. So obviously, if I were to go short now, it would be a risky kind of decision. But what I want to see is, I want Bank of America to base sideways along this 20 MA, this orange line, and then ultimately, okay, what I want is, I want it to go lower, okay? And as far as targets for Bank of America, let me see if I can find any trend lines right here. Okay, there you go. You have a little bit of a trend line right there. And let's see here. Okay, maybe this is a good trend line as well. So as far as targets, you know, if Bank of America wanted to go lower, ultimately, if you were to maybe short it around this level, and it puts a, you know, a really nice consolidation pattern, maybe it might get you down here to this level, okay? This level around 1140-ish for a short term bottom, and then maybe, if you're lucky, around this $11 area for your targets. However, don't short it yet. I'm gonna say it, I'm gonna put it out there. Wait for this consolidation pattern, and we will have to look at it on a day-by-day basis. Maybe tomorrow Bank of America just shoots up and puts in this green candle. At what point this wouldn't be valid anymore. But if you get this consolidation pattern, then maybe eventually you could be able to short it. But another reason why I'm actually talking about financials so much, besides the fact that I actually love trading them, is that we see some divergence. So, you know, if you look at Bank of America, it's been going down since the 19th of March, right? Go back to JPM. JPM has been going down since the 14th of March. So JPM started even earlier. Let's look at Goldman Sachs. Goldman Sachs actually was strong today. However, Goldman Sachs has been going down actually even since February 19th. Look at the spiders. The spider, okay, went up. It's been going up until the 14th of March, but now it's basically going sideways. What are financials doing? Financials are going lower. And the last time we had a sell-off, it was the financials leading the markets lower. So this time around, it might be the same thing. Now I'm going to reveal a little bit of a secret to you that I usually don't tell people, okay? And it's the XLF. XLF is the component of the SPY that tracks the financials. And let me just look at the monthly right here. Now, the XLF is a really good chart to look at because it's very, very symmetrical, okay? And it had a rally between March 2013 until around June 2007, and then it sold off. And it started another rally, okay, 6 years later, the same month, in March 2009, okay, and it's been rallying since. Okay, so we see a little bit of symmetry, and I'm not going to go into this because it will be, number one, proprietary information, number two, it would take me an hour to explain this to you. But if you want to pause this chart and just look at it on a day-by-day, month-by-month basis, you will see that there is a lot of symmetry, and especially time symmetry, because we topped out in June 2007. So now the question is, do we top out in the financials around this June or maybe even May? So we, in all fairness, we also had a top in May. So like, it's these little signs, and you put them together and they tell you ultimately what the market is trying to do. My target for the XLF is around 1920. So maybe if the XLF were to shoot higher into 1920, then ultimately I could be more convinced of some sort of downtick coming in the markets. But again, we have to look at it day by day. Okay, now another thing I want to look at is, I believe, the JJC. Now the JJC is copper, and if you're a student of Jesse Livermore, you know that Jesse Livermore made a ton of money by predicting copper in the markets. Look at copper. What has copper been doing? And we're not talking about months, we're talking about years. Since 2011, copper has been going sideways, not participating in the markets at all. Okay, and if you look at these kind of inside bars, you have these three major inside bars on the JJC. Now, okay, this month we actually broke below this area right here, this inside bar. Now we're trying to take out this inside bar. So if we get below this $43 level, look for this inside bar to be taken out. But ultimately, if JJC gets below $40, expect major downside. Look at it here. Last time we had a downside, JJC doesn't move a little, it moves a lot. Okay, and there's a lot of other charts that I can look into. I'm not going to go into that, but one thing I wanted to show you is FedEx. A lot of those transport stocks have been ridiculously extended. They have been high like crazy, they just don't stop. But FDX might be the first crack in this in these transport stocks. And now every day in my videos I keep telling you, don't short FedEx yet, give it a little bit more time to consolidate. But then if you do short it and it has done this consolidation, then ultimately you can expect some really nice downside for a really nice profit. The first target is your 200 MA, but ultimately FedEx looks like it wants to go to this 91 70 area, maybe even lower based on this pattern. Okay, so give it a little bit more time. The longer it bases in this pattern, and it's been doing great. Okay, it's been putting in a really nice bearish consolidation, but the longer it bases right here, the lower it will go. Okay, definitely don't buy FedEx. Okay, short it if you must, short it. Okay, now let's look at the intraday charts real quick. Now if you follow me on Twitter, you know that I actually give out charts as I take them, so there's no BS out there. I don't alter anything. You see it timestamped. You know when I took it, you know what levels I took, you know what level I exited, you know if I broke even, if I lost, if I won, or whatever. Okay, so the first trade I alerted you to in intraday was Facebook, and I alerted you to Facebook at 25.66. Okay, so let me just zoom in real quick here. There was a really nice level around the 200 MA right here. So if you got it right here at this top and you shorted it, you could have made some really nice money. Okay, you could have made about 30 cents or so. Okay, just off of 10 minutes of the chart. I personally took only 8 cents out of it because I wanted to have a safe trade. But guess what? I made over $400. So imagine if you had waited all the way down here, how much you would have made. And I don't trade off of big accounts. I have a very small account, and I have my leverage for my intraday, and that's it. So don't think that I'm putting out millions and millions of dollars into my trades. No, I'm just a regular day trader looking for technical levels. and this was a good level, and I made 400 and something, I believe 430 or something dollars off of it. So that one was a winner. Congratulations if you took it. I gave out that trade for free on Twitter. The next one was gold. GLD, I alerted you for a long, and I said around the 155 area. And sometimes I tell you exact areas, exact levels, and sometimes I'll tell you areas. And you know, this one was, I said area because you know sometimes you get filled at the 155 level, but sometimes somebody will pick it up at the MA. And right now, you know, we at this time we were at the 20 MA, and I figured, well, okay, we're in this light volume part of the day. Let me pick it up here. I picked it up right here at 155.03, I believe, and I took a really nice profit. So I told you to go long right here in this candle, and I covered. I sold my first half at 155.19 right here. Okay, so let me just give you some lines so you don't think I'm just showing you things. Let me see here. Change it a little bit. Okay, so I got in here. Okay, then my next level, I sold it around 155.19. I wrote it up to here, and as soon as I make a little bit of money, what I do is I put in a break-even stop and I let my money ride for me, and that's what it did. I took my other profit right here at the 155.30-ish level. So congratulations if you took this trade. Another winner given on Twitter for free. Okay, third trade that I gave you guys was FCX. I told you to short FCX at 33.03 right here on this green candle. I had a really good technical level, but I wasn't expecting much out of this trade because the market was going higher, because we were in the light volume part of the day. I saw a technical level, and that's when you need to control your risk. Okay, new traders, when they're in a trade, they don't want to lose. They don't want to lose, so they just let it ride. So if you didn't control this trade like you were supposed to, if you didn't manage your risk, you could have gotten taken out. And if you were stubborn, you would have lost a lot of money. And again, watch my lessons. Watch my lesson number 1 and lesson number 2. It tells you everything about this behavior and why traders fail. They're too stubborn to close their losers. However, I'm going to show you what I did today and what you should be doing and how to do it right. Okay, so I shorted it here at 33.03. I wasn't expecting much. Like I said, the market was moving higher, light volume part of the day. I waited for the red candle because I know it's gonna get bounced off of that level, right? It's gonna get rejected. So it got rejected, it bounced down, okay, and I took my profit at 32.95. okay, I covered my first half at 32.95. I'm still letting my money work for me, right? Because I'm in the money already. However, your second half you put in a break-even stop. So even if it gets back there, right? No big deal. You're at break-even. So half of my money, half of my trade here made me about 8 cents, and then the other half I got stopped out. Guess what? I made money. Okay, so all those three, I made money off of them. I made about $730 or something today off of these 3 trades, and that's all you need for day trading. You only need a couple of trades. If you trade more than 7-8 trades per day, you are over trading. You are losing money more than likely. Okay, now in my last video for yesterday, I believe I alerted you to 2 energy stocks, XOM and Valero, and I told you that they were strong. And I told you wait for a little bit of a pullback. Don't buy it right at the open. Wait for a little bit of a pullback and then go long if you see a pattern. Now, XOM right here, okay, had that little bit of a pullback, okay, but it was strong, okay. So if you were able to find some sort of pattern, some sort of level, congratulations, you did well. Valero was a little bit more tricky. Valero kind of was trying to trick us here because the market gapped down in the morning, but Valero gapped up. Okay, so Valero got ahead of the market, and then, you know, I guess once these buyers noticed, well, wait a minute, the market gapped down, and you know, what is this Valero doing? It reversed down and kind of just basically went sideways. Not much to make out of this trade, really, out of this stock. It went up, reversed and just basically went sideways, flat, just like the spider. So not much to do here. However, if you took the ExxonMobil, congratulations. Now another one I want to show you is CLF. CLF today, just horrible chart. And I believe it's based on some news or some downgrades. I don't know. I don't care about the news. I just care about the charts. Now CLF gapped down with the market, but it failed to reverse. The market basically closed flat on the day. CLF just basically consolidated on the same level. And if you look at the daily, CLF just has been bleeding lower since February. So this company just looks awful, you know, and then today it gapped lower. So it doesn't look good at all. And on a longer term, let me look at the weekly for CLF. Let me just zoom out a little bit. And I want to show you this CLF chart. It looks scary because actually the CLF has a head and shoulders pattern right here on the weekly. Okay, so here's your shoulder, left shoulder, your head, okay, then your right shoulder, okay, and then of course it keeps going lower, and then your neckline right here would be, let me just zoom in here so I can really figure out the detailed neckline. Your neckline on on CLF would be right here. Okay, so technically this head and shoulders pattern broke down in June of 2012. It got triggered around that time. But if you know how to calculate the ultimate targets for head and shoulders, you know, this takes you to zero. Okay, so the question now is, do we trust the technicals? Because the technicals tell us that CLF is going out of business. Okay, or, you know, do we just assume that this is some sort of bogus pattern, and that it's just the way that this stock is trading? So it's up to you, but to me this is telling me that CLF is going out of business. I'm not talking about tomorrow, but either way, within a couple of years, it looks like this head and shoulders pattern wants it to go to zero. Now, on a more of a short-term basis, maybe in a couple of months, I see a little bit of support right here at 1160 on CLF. So don't buy CLF here if you're a long-term swing trader. You will regret it because it will go lower. Now, you know, in a couple of days time or so, we might get bounces, obviously, but on a longer term scale, talking about weeks, months, maybe even years, CLF looks horrible. Okay, now I know this video is getting very long, already at 38 minutes, and hopefully you stuck around to actually watch it. But as far as tomorrow, what do we expect? Tomorrow I expect a little bit of upside. Okay, obviously, you know, we know why. Media wants to put some sort of headline out there, how everything is great in the spiders, you know, this and that. Oh, we're approaching all-time highs, or whatever they're going to tell you. And, you know, they want you to buy into the weekend. They want you to think that, you know, this is going to be a great Easter, and hopefully will, and that you will be out there buying your Easter eggs and baskets and whatever you need to buy, outfits and, you know, all that stuff. So tomorrow I expect a little bit of upside, and maybe, you know, we're into this resistance right here, but it got tagged already 3 times, so maybe we gap above this area, this 156.26 area at the open. I wouldn't be surprised if we get a gap. We've been having gaps for almost 2 weeks. It's just a question, do we get gap ups or gap downs? Okay, if we, you know, if there's no news out of Cyprus, you know, we had this great bullish day on the markets, you know, of course we're going to see upside in the markets, and the Fed would love that, media would love that, you would love that, because you want to go out there and shop, right? But if we get some sort of bad news in Cyprus and the banks open up and everybody's withdrawing their money, or maybe we get some news out of Spain or Italy, then we're going to get a gap down. Okay, but me personally, I'm about 70% confident that we have an update tomorrow. So hopefully you watched this video. I'm sorry that it was this long, but I wanted to show you some of my details, some of my proprietary cycle work, and join me at tradethesestocks.com and especially on Twitter. Follow me on Twitter if you want to make $730 or so day trading. If you don't, that's okay. Just stick to whatever you're doing. Maybe you're doing better than me, okay? However, just follow me on Twitter. Keep watching these videos. If you're doing poorly and losing money, which you shouldn't be doing as a trader, watch lesson 1 and lesson 2 to get your psychology right, okay?